Good morning, everybody. So I'm here in a very, very brief whirlwind 10 minutes to let you know what you need to have and to avoid to be a successful portfolio builder and a successful investor. So what do you need to have in simple terms? You need to have a plan, a style, an edge, and a margin of safety. And what you need to avoid as best you can are excitement, and I know we're all going to have a lovely time here today, and expenses. And I say that, remember, I work for a platform provider which will take a commission every time you trade, and I still say you've got to be very, very careful about how you rack the expenses up. So what do you need to have to really help make your portfolio work for you? You need a plan. You need to know why you're investing your money. You need to know why you are putting your capital at risk. So you need to know what you're investing for, over what time period, and in terms of your target return, that will be dictated by how much you have now, where you want to get to, and over what time period, and then that will help also determine how much risk you have, or more pertinently, are prepared to take. Now, risk in an investment context can only be really defined in one way: capacity to stand permanent loss of money. People talk about volatility as risk. That's just share prices doing that. If your portfolio is sufficiently robust to allow you to come through that, it just doesn't matter what a share price does over a period of time, so long as you're not a forced seller through financial circumstance when the share price does that. That's volatility. Volatility is even an opportunity to buy securities cheaply or sell them expensively. That's not risk. Risk is losing your money on a permanent basis and finding yourself a forced seller at an inconvenient time. So the answers to those questions of goal, time horizon, target return, and appetite for risk will then shape how we want to build your portfolio and what works best for you. There's no one single answer. You, sir, may want to be a trader. You, madam, may want to be a long-term investor. But it will condition your approach to building your portfolio, the asset classes which are best for you relative to risk. If you're low risk, you may prefer high-yielding equities or bonds, though whether bonds are low risk now is probably an open question. If you're more aggressive, you may look at things such as biotech stocks or tech stocks or higher risk equities. It will also, with the most suitable instruments. You may just prefer vanilla equity. You may prefer foreign exchange. As an asset class, you may prefer spread betting. You may prefer warrants. Again, much more risk involved, much more complex products. Most people, I think, will probably keep it fairly vanilla. But if you're particularly confident and particularly aggressive, there are some things that you can use to help you along your way, so long as you know what you're doing. And that will, in terms of what you're looking to trade or looking to invest in, will shape who is the best platform provider for you. Vanilla, again, vanilla through funds or through equities or through some more esoteric geared instruments. So you need a plan. If you haven't got one to start off with, you might as well go to Sandown Park this afternoon and put your money on Mr. McCoy just because it's his last day as champion jockey, because you're doing nothing more scientific than that. So, style, trader or investor? Long run, and I'll prove it to you, investing is the right way to go, but it does require iron patience. Speculation, you're just timing the movement of money, second guessing what people are going to be buying. If you're investing, you're looking for assets that have got intrinsic value, generate cash, and a proper business model. Remember, share certificates are not lottery tickets. They are not betting slips. You actually have a stake in a company, and therefore you need to make sure that it's run properly with your interests in mind, and above all, it generates cash so it can pay you dividends, because that's really where the returns tot up, as I'll prove to you in a minute. I know Mr. Getty was a rich man when he started, but he was an even richer man by the time he finished by following this simple discipline. An edge. Let's think about it. Every time you buy security, you're telling the market it's wrong and that it's inappropriately valued. You're telling the market 7,000 hedge fund managers, 53,000 pension fund managers, however many it is all around the world, people who live, eat, breathe and drink this 24/7, you're telling them they're wrong. Now that's a big call to make. I'm not saying it's wrong to make that call, but I'm saying you've got to have a jolly good reason in your own mind why you're doing it and why you're telling a lot of smart men and women they don't know what they're doing and that you do. Now, the market cannot always be right because none of us would ever make any money. So efficient market hypothesis, we can park that right now. It's a nonsense, okay? But you still need a good reason why the market's wrong, and with the help of my good friend Michael Cahill, who used to work with me at UBS Investment Bank, he's let me talk about this framework that he's devised in his book, which is a 3D matrix of growth, risk and quality. Now, most people will focus on growth. for understandable reasons. It's exciting, it gets share prices going. But all I would say to that is, remember, Sir Fred Goodwin grew the Royal Bank of Scotland, and he blew up the bank. So it's a matter of how you grow the business, preferably organically, preferably patiently, and again, it's therefore a matter of how that growth is generated. If the growth risk, Mr. Goodwin again, how much risk is there involved in the business? There's lots to choose from. Operational risk, management risk, financial risk is always the big one. Does the business have too much debt? Is money being dragged away in interest payments, preventing it from investing in the core of the business? Think about Tesco's. Had it spent all of its time investing in its UK franchise and not trying to sell rice to the Vietnamese or salads to the Americans, it might not be in the mess that it's in now. It tried to grow too fast, too quickly. Quality. Quality is defined by predictability and by cash. Because again, cash is the ultimate measure for any valuation. So if you think about it, if a company, in your opinion, has the same growth, risk and quality profile as an average British company, it will trade in line with the UK stock market in 14 times earnings. Roughly. If you think the growth is better, the risk is lower and the quality is better, it will trade at a premium, and vice versa. Just to give you one example, Finsbury Foods was a company which basically makes cakes for Tesco's and supermarkets. It sold its gluten-free business. The debt disappeared, the company was therefore much safer, there was less risk, and the quality of earnings was therefore higher. So the company wasn't growing still, because it's a pretty difficult market in which to grow, but risk was lower, quality was higher, and the share price rocketed. So again, you need to take a 3D view of companies and not just focus on that, because that's what can get you into trouble very quickly. Margin of safety is ultimately valuation. Yes, we all know a good narrative. Markets love narratives, and that's why in the short term it's a voting machine, but in the long run it's a weighing machine, as Mr. Graham said, and that means cash. Again, ultimately cash flow dictates valuations. As we all know, price is what you pay, value is what you get. Arm is a brilliant company. They're not here today, but they reported numbers this week. They're based in Cambridge. It's a fabulous semiconductor architecture design company, but you could have bought it for £10 in 2000, 35 pence in 2003, and you can buy it for £10 today. It's the same company doing the same thing. One of those prices provides you with a massive margin of safety, one clearly doesn't. Again, that's volatility, and that's how you can actually take advantage of it, by focusing on the valuation of the asset. I haven't got time to tell you how to do it. Come and see me on stall 49 and I will do. So that's what you need. What do you need to avoid? We're all having a great time today. It is very exciting to be here, but this is a patient person's business if you're invested, particularly if you're investing. And this is from Mr. Buffett. Now I know lots of people go, oh God, not him again, how boring, having to listen to Mr. Buffett, 83-year-old who lives in the middle of nowhere. But just look at his investment track record. This is Berkshire Hathaway relative to the S&P 500. The red line's the S&P. It's gone from 600, it's basically more than I think it's gone up. It's gone from 60 odd to 1200. So it's risen in the last 50 odd years. And just look at how much Berkshire Hathaway's outperformed it. So he has followed these metrics to the T. The records are there to speak for themselves. And this is all about patience. That's a very, very long-term chart that we've just seen. This is an equally long-term chart. And again, if you're investing for your pension, you're investing on a 40, 50-year view. If you think about a company, if it's paying a 3% dividend yield, it will return to you in cash its market cap in 33 years. So an equity is effectively a 33-year duration instrument. That's the time horizon you're investing on, pretty much. So the blue line here is cash, what you've got on a compound return basis since 1964. This line here is the FTSE All Share, 7% compound a year, but with no dividends. This line is the FTSE All Share, banking your dividends and reinvesting them every year. Now that dividend yield is only 3.5% on average, but if you buy more shares with those dividends over a very long period of time, the results are absolutely spectacular. You might not notice the difference for the first 20 years, but over 40 or 50, the eighth wonder of the world, the law of compound investing, comes to your favour. So it might not be very exciting banking those dividends every single year, but financially, and that in the end is why we're doing it, the results are pure mathematics. The hard work then comes down to finding the companies that can sustainably pay those dividends. But you can find investment trusts that can do it. They've done it for 40 odd years running. But lots of companies with strong brands, strong pricing power, strong names and good competitive positions will do that over a long run. Yes, the shares will do that with the market, but they'll still be in business and they'll still pay you that cash. Now, my boss is in the audience here, so I've got to be awfully careful what I say about expenses. But remember, every time you trade, even with us, that's £5 from you to my Christmas bonus pool. And my Christmas bonus pool goes on Lego for my kids. So if you think about it, please don't make me unhappy by making me having to build all that Lego. My kids are spoiled rotten anyway, and that £5 belongs in your pension. So yes, we all need to deal, we all need to adapt our positions, but just because there are very efficient platforms that are very cheap, that will allow you to trade in liquid instruments very easily, doesn't mean you have to do it every 5 minutes. Again, as we've proven on the previous slide, patience is key. Yes, top up your positions, reinvest your dividends, but if you've got a strategy that's working, don't second guess and don't chop and change. And again, we're all here today on a weekend, but if you enjoy not looking at a screen Saturday and Sunday, try it, don't do it on a Monday to Friday, just stick to the master plan. So the conclusion is, and I'm on 9 minutes, that's not bad going, have a plan, have a style, take a 3D view, and ultimately it's all about cash flow and harvesting dividends in the long run if you're an investor. I'm not going to say don't be a trader, I'm just going to say that you're making it harder for yourself, because if you think of the way those dividends compound, the fees compound in exactly the same way, eroding those returns. Valuation is the ultimate arbiter of your return, and in the end, although it's great to be here, and I'm looking forward to talking to you on stall 49, excitement and expenses are ultimately what will work against you unless you're very, very good, or very, very lucky, or very, very careful. So thank you very much for your time, everybody. I greatly appreciate it, and look forward to seeing you during the rest of the day. Thank you.